So coming to the next one, IAS 2, so inventory valuation. So in case of inventory valuation, first we have to know what is meant by inventory. So generally, inventory is defined as those items which are held for what resale purpose. Those items which are held for what resale purpose. But coming to the manufacturing entity, so inventory includes assets held for sale in the ordinary course of business and those assets which are in the process of production of the finished product and those goods or those items which are purchased for process of the production. Simply said, it includes raw material, means that goods which are purchased for process of production of the finished product, which are remains in the process of production called as work in progress, and which are produced out of the process of production called as finished good, and which are consumed in the process of production are called as consumables. These are all covered under the definition of inventory. But IAS2 does not apply. So it does not applies in some cases. So it does not applies to the work in progress arised in the process of construction contracts. In the process of construction contracts. So that what we are going to discuss in IFRS 15. That is nothing but what a revenue recognition. And it does not apply to financial instruments, so which are held for resale purpose. There it does not apply, and it does not applies to the biological assets. It does not applies to the biological assets. And coming to the main objective of the inventory valuation, IAS2 is to prescribe the what is the accounting treatment for the inventory. So what is the accounting treatment for the inventory? So generally, inventory is valued at cost or NRV, whichever is less. So it is valued at what? Cost or NRV, whichever is less. And this is framed as per which concept? Conservatism. Conservatism. Here we have to define what is meant by cost and what is meant by NRV. So cost is a nothing but. So generally cost includes what? So cost includes the purchase price of the inventory. So any expenses incurred at the time of purchase, any expenses incurred at the time of purchase, and amount spent for conversion called as conversion cost. Amount spent for conversion means for converting the raw material into the finished product, how much amount to spend, that amount is said to be about conversion cost. That amount is said to be about conversion cost. And those expenses which are incurred to bring that inventory into saleable position or saleable condition. So those are included like packing. For example, food items are there. So once food items are produced, those cannot be sold without any packing. Then packing is mandatory for bringing that food into the saleable position. That packing is forming part of the cost of inventory. But this cost of inventory does not include, that is nothing but it excludes some items. So which items are excluded? So abnormal cost is excluded, and office and administrative expenses are excluded, and selling and distribution cost is excluded, and storage cost. So storage cost is excluded, and finance cost is excluded. But coming to the finance cost, one more thing is defined. So finance cost is included in the cost of the inventory if it is meant for qualifying asset. If it is meant for qualifying asset. If the inventory is not a qualifying asset, then finance cost is not included in the cost of the inventory. And next one, foreign exchange differences arising directly on the recent acquisition of inventory invoiced in foreign currency. So, foreign exchange differences arised, if any. Differences arised, if any. So, which are arised directly on the recent acquisition of inventories invoiced in foreign currency. So, these are all excluded. So this is what is meant by cost. It includes these items, it excludes these items. So here, one of the important thing is nothing but conversion cost. While calculating conversion cost, some elements are there. So it comprises what? Conversion cost. It comprises of costs which are specifically attributable to unit of production. So that is nothing but what? Direct labor, direct expenses, and direct material, etc. And coming to the production overhead. So in case of production overhead, there are two ways are there. One is variable overhead and another one is fixed overhead. Variable overhead and another one is what? Fixed overhead. So generally, variable overhead is allotted based on actual capacity and fixed overhead is allotted based on normal capacity. Allotted based on normal capacity. Correct? So variable overhead is allotted based on actual capacity and fixed overhead is allotted based on normal capacity. Normal capacity. So other overheads, if any, attributable in particular circumstances of the business to bring that product or service to its present location and condition. Nothing but what? Saleable condition. Those are all included. So, and coming to the exclusions, these are our exclusions. So this is what is meant by cost. Then coming the next one, NRV. NRV stands for what? Net realizable value. Net realizable value. So NRV includes, NRV is nothing but what? So estimated selling price, estimated selling price of the respected product, estimated selling price of the respected product minus minus estimated cost of completion of the product minus estimated cost to make the sale of the product. To make the sale of the product, so is called as what? N or V, net realizable value, NR. Okay. So inventory is generally valued at what price? So cost or NRV, whichever is less. Cost or NRV, whichever is less. So that is what? Valuation principle. And remember, this principle has to apply on item by item, not on, but not on group wise, but not on what? Group wise. So what is this meaning, sir? So for example, A, B, C is there, and here the cost and NRV is there. For example, 180 and 150 and 120 is there, and 200 and 380 is there. Then we have to apply this principle cost or NRV separately for A, separately for B, separately for C. And don't calculate in this way. What is the total cost and what is the total NRV among them, whichever is less. This type of application is not possible. So means we does not apply the respected principles on group wise. We have to apply the principles on item by item, item by item. Then coming to the next one, methods for valuation of inventory. For this purpose, so inventory is classified into the two types. For this purpose, inventory is classified into the two types. One is inventory ordinarily interchangeable and inventory which is not ordinarily interchangeable. So inventory which is ordinarily interchangeable and not ordinarily interchangeable. So what is meant by not ordinarily interchangeable? Not ordinarily interchangeable means customized products. Customized product. For example, you purchase the raw gold, and you give that raw gold to the maker of the ornaments, and you want to manufacture, you want to use that raw gold to make the ornament, and you give the contract to the ornament maker. So here you supply the raw material as per your instruction. The party prepare the ornament and give it to you. So here that is called as what customized product, and the product cannot be sold by the maker to the another party. So it cannot be interchanged with the another party. It cannot be interchanged with another party. So in this case, they prepare one job sheet. They prepare in one job sheet. In the job sheet, it clearly identify what is the material and what is the labor, what is the expense. So these are called as what specific identification method. Specific identification method is that. But coming to the gold shop, if you go to the gold shop and verify, and there are a number of ornaments are there. For example, if you select the one ornament which may be rejected by another party, if you reject the one ornament which may be selected or which may be accepted by another party, means that ornament, if you not buy the ornament, another party can buy it. So they can interchange and they can sell the product to the another party if you does not accept. That type of items are called as interchangeable. Interchangeable. So in this case, so we use the word FIFO method, FIFO, first in first out method, and another one is a weighted average cost method. Weighted average cost method. Weighted average cost method. And previously LIFO method is also there, but LIFO method at present not accepted. Last in first out. Last in first out. So here FIFO method stands for what? First in first out. Means the goods which are purchased first or issued first, means the latest purchases remains in closing stock. The latest purchases remains in closing stock. So in case of FIFO method, the goods are issued in the sequence of their purchases. The goods are issued in the sequence of their purchases. Then coming to the weighted average cost method or average unit cost method, average unit cost method. In this case, they need to calculate what is the weighted average price per unit. What is the weighted average price per unit? How to calculate? So the total cost of goods available for sale by total quantity. Total quantity. So that is nothing but what? The total value of the opening stock purchases, whatever may be before the respected sale, by what is the total quantity. Then we get our weighted average price per unit into number of units. Then we get what is the value of closing stock as per weighted average price method. Weighted average price method. Then coming to the disclosure aspects. The main disclosure requirements is relating to what accounting policy adopted, including the cost formula. And means already we discussed while calculating the cost, which items are included, which items are not included. What is the total carrying amount classified appropriately, and the amount of inventory carried at NRV. Like damaged products are valued at what? NRV. Byproducts are valued at what? NRV. Amount of inventory recognized as an expense during the period. Amount of inventory recognized as an expense during the period. That is nothing but what? Cost of goods sold. Cost of goods sold. and details of any circumstances that have led to write down the inventory to their NRV. So why the value reduced to the NRV? So here we discussed cost or NRV, whichever is less. Is there any reduction in the value that is ultimately transferred to a statement of the profit and loss? Statement of profit and loss. So this. And here, value the following items of inventory. Material costing $12,000, brought for processing and assembling for profitable special order. Since buying these items, the cost price has fallen to 10,000. Has fallen to 10,000. And equipment constructed for a customer for an agreed price of 8,000. This has recently been completed at cost 16,800. It has now been discovered that in order to meet certain regulation, conversion with extra cost 4,200 will be required. The customer has accepted partial responsibility and agreed to meet half the extra cost. So half the extra. So here in the first one, what is the material cost? 12,000 is the material cost. 12,000 is the. So here the material costing 12,000 brought for processing and assembling for profitable special order. So generally inventory is valued at what price? Cost or NRV, whichever is less. Here cost is around 12,000. But NRV is not stated in the problem. So, but he clearly stated it is a profitable special order. Generally, NRV is in case of profitable orders, NRV is more than cost. So we have to value the inventory at 12,000. Then what about this 10,000, sir? This is called as what? A replacement cost. But a replacement cost is not relevant for valuation of what? Inventory. So we value the inventory at what price here? 12,000. Then next, coming to the equipment constructed for a customer agreed price of $18,000. This has recently been completed at a cost 16,800. And it has been now discovered that in order to meet certain regulations, conversion with extra cost 4,200. So here, what is the agreed price of the customer? 18,000. 18,000. So this is called as what? NRV. So net realizable value. Net realizable value. And what is the cost? So generally cost incurred 16,800. But for meeting certain regulation, he has to spend some extra cost 4,200. Then how much amount required to incur? How much amount he required to incur? So around 12,000, around 12,600. 12,000, sorry. So here the total cost was spent by the party 16,800. So this is nothing but what? An extra cost incurred to meet the certain regulation while making this set. So this is nothing but we have to consider while calculating the NRV, net realizable value. So the NRV is nothing but what? 18,000 minus additional cost incurred to make the sale of the product, estimated cost to make the sale. Nothing but how much? 4,200. But here the customer has accepted partial responsibility and agreed to meet half of the extra cost. What is the extra cost? He spent 4,200. Half of the amount spent by the customer. So he need to spend how much amount? For 2,100. So how much? 9, so 15. So 15,900 or 16,800, whichever is less. So 15,900 is the value. 15,900 is the value. Clear? Okay. So this is what valuation of inventory.